Hi, Professor Barati. I'd like to go over week two's first PowerPoint, which I think is the key part of this week's objectives. It basically gives us an overall summary of what an audit objective is, pertaining more towards financial statement audits. So basically, the last few slides in the PowerPoint summarizes the audit very well. Phase 1, plan and design an audit approach. The main objective of an audit is to accumulate enough evidence to provide an opinion on financial statements. The overriding considerations affect how an auditor approaches the audit. So in other words, the auditors will put together an audit plan, but that plan will be decided on how certain things go within the audit. There must be sufficient evidence accumulated to meet the auditor's professional responsibility. What that means is the auditor must have evidence such as trial balances, bank reconciliation, bank statements, cash receipts, cash checks, things of that nature, in order to substantiate balances and transactions that go through the general ledger and trial balance. If the auditor finds that that type of evidence is not available or readily available, it will require that the audit go further into testing. It will require more tests. So for example, if there's X amount of dollars on the cash balance sheet, and a company has every month's bank statement available with bank reconciliation signed off and dated by the controller, that'd be a good form of evidence and internal control as well. If that part of the audit shows weakness, the auditor will most definitely do more testing and see that there's risk involved for errors. So the cost of accumulating this evidence should be minimized, but again, the company that you're auditing, it is their responsibility to basically keep good books, to keep good record keeping. Phase 1, plan and design the audit approach. Risk assessment procedures include the following. Obtain an understanding of the entity and its environment. So in today's modern audit, the focus has become more and more on the auditors knowing the business cycle, the nature of the business, the competition, the environment that it's in. So for example, an auditor will take a very different approach towards auditing an insurance company versus auditing a retail shop or a small manufacturing company. The auditor must become pretty well versed in that business and its industry that it's in, so that it can compare its transactions and statements to its competitors. From there, an auditor can determine the risk involved. An important part in auditing today, which has also moved away from a lot of testing and number crunching, auditors are moving more towards understanding internal control and assess control risk. Internal controls are extremely important in today's complex systems. Before software, it was actually easier to do audits. With the advent of general ledger ERP systems now, internal control is extremely important, and auditors spend a lot of time evaluating that internal control, because weaker controls will lead to risk. And risk in this nature in auditing is really basically determining the chance of error and misstatement, material misstatement. That's what we mean by risk. Not that the business will fail or go out of business, not a financial risk, although that could be determined in an audit as well. Every financial statement audit now comes with management's discussion on internal controls. Internal controls are part of every aspect of the business. It's part of operations. It could be how you receive inventory, how it's received, how it's signed off, who signs off for it, how it gets put into the factory, who's responsible for it, how it gets costed. Internal controls are very important in cash management. How cash is received in, how it's transacted on the books, how it's controlled, responsibilities, and so on. Is the person who is depositing cash or putting cash in the bank also doing the bank reconciliation? That would cause some risk. Accounts payable must have internal controls, such as, do they have access to checks? Who can sign the checks? Do certain amounts greater than a certain dollar require more than one signature on a check? Who's monitoring the transactions that go through the checking account, and so on? All that's determined through the internal control audit approach. Depending on how good the internal control is and the risk assessment will determine phase 2, performance of tests and controls and subsequent tests of transactions. Here is where the hands-on, what I like to call the number controlling, the number crunching part of the audit is. Tests of controls allow the auditor to evaluate the effectiveness. Tests of controls allow the auditor to evaluate the effectiveness of internal controls and determine whether the controls can be relied upon. Subsequent tests of transactions allow the auditor to evaluate the client's recording of transactions. So here, the auditor will actually go in and test the different transactions that are recorded on the books. Again, that's where evidence comes in, and that's where controls come in. Phase 3, perform substantive analytical procedures and tests of details. Analytical procedures consist of evaluations of plausible relationships among financial and non-financial data. What that means is, as we know, accounting is basically the performance of debits and credits. There are relationships. There's relationships between cash and receivables, between sales and receivables, between accounts payable and cash. Those relationships must be consistent. Auditors look for that plausible relationship and if it makes sense. They then test details of balances, specifically, and procedures intended to test for monetary misstatements in the financial statements. Phase 4, complete the audit and issue an audit report. After all procedures have been completed, the auditor will reach an overall conclusion as to whether financial statements are fairly presented. After the conclusion, auditor must issue an audit report that will accompany the client's financial statements.